Welcome to a world where the stock market feels like a high-stakes drama, and you're not just a spectator, you're part of the action. The stock market crash of 2024 has left many of us with more questions than answers. Why did the tech titans stumble? How do interest rates keep us on our toes? And why does it seem like every time we think we got it figured out, the market throws us another curveball? In this video, we're diving into the heart of the chaos to uncover the strategies that can help you not only survive, but thrive in this unpredictable landscape. Along the way, we'll explore the secrets of diversification, the power of keeping a cool head, and the art of spotting opportunities in the midst of uncertainty. So, here's a cheeky question to get you thinking. If the stock market were a reality TV show, would you be the savvy strategist, the cautious observer, or the daring risk taker ready to shake things up? Grab a seat and let's find out how you can play your part in this financial saga. Chapter 1: Understanding the Stock Market Crash. The stock market crash of 2024 has been a wild ride, hasn't it? It's like watching your favorite TV show take an unexpected turn, leaving you on the edge of your seat, wondering what happens next. One moment, the S&P 500 is soaring, and the next, it's in a free fall. The Nasdaq too has taken a nosedive, leaving investors and onlookers alike grappling with recession fears and uncertainty. So what led us to this financial drama? Let's break it down. The market's decline can be attributed to several factors, each playing its part in this unfolding story. First, there's the dreaded specter of a recession. Economic indicators have been flashing warning signs, with unemployment data showing a troubling rise. It's like that ominous music in a thriller, signaling that something big is about to happen. Meanwhile, consumer spending has slowed down, adding to the anxiety and making everyone wonder if we're heading for a downturn. And then there's the tech stock overvaluation. Remember when tech stocks were the superheroes of the market, saving the day with their skyrocketing valuations? Well, it turns out they might have flown a little too close to the sun. Investors are now questioning whether these stocks were worth their weight in gold, or if they were just inflated by hype. But here's the thing, every market crash brings with it a silver lining. It's a chance to reassess, to learn, and to prepare for the next chapter. Yes, the headlines can be daunting and the numbers might look grim, but this is also an opportunity to gain perspective. It's about understanding the ebbs and flows of the market, recognizing patterns, and making informed decisions. As we navigate this financial roller coaster, it's important to stay grounded. Keep an eye on the economic indicators, but don't let them dictate your every move. Remember, the market is a living, breathing entity, and like any good story, it has its ups and downs. The key is to stay informed, stay resilient, and remember that every downturn is just another chapter in the larger narrative of the financial world. Chapter 2: The Recession Fear Factor. As we continue to unravel the implications of the stock market crash of 2024, it's clear that the fear of recession is casting a long shadow over the economy. The sudden downturn has left investors and everyday folks alike questioning what's next. Unemployment data is showing an uptick and consumer spending is slowing down, painting a picture of uncertainty that feels all too familiar. The impact is being felt across various sectors, but let's focus on three that are particularly affected: consumer goods, technology, and financial services. In the consumer goods sector, companies are grappling with a slowdown as people become more cautious with their spending. It's a bit like tightening your belt after a holiday splurge necessary, but not exactly fun. Meanwhile, the technology sector, which has been riding high on optimism and innovation, is now facing scrutiny. The tech stock overvaluation that once seemed like a badge of honor is now a point of concern. Investors are asking tough questions about whether these companies can sustain their lofty valuations. Even Warren Buffett, the Oracle of Omaha, recently made headlines by selling off a portion of his Apple stock, signaling a shift in sentiment that has many wondering about the future of tech giants. In financial services, the landscape is equally challenging. With interest rate cuts on the horizon, banks and financial institutions are navigating a tricky path. The potential for lower rates could mean slimmer margins, prompting a re-evaluation of strategies and priorities. Amidst this backdrop of recession, fears, and market volatility, it's important to remember that every challenge is an opportunity in disguise. The key is to stay informed and adaptable. Look at the broader economic indicators, but don't let them dictate your every move. Instead, focus on building a resilient portfolio that can weather the storm. As we move forward, let's take a page from the playbook of seasoned investors like Buffett, who understand that the market's ups and downs are part of a larger narrative. It's about playing the long game, staying patient, and recognizing that today's challenges can lead to tomorrow's successes. Chapter 3: Interest Rate Dynamics. As we delve deeper into the stock market crash, the role of interest rates becomes increasingly significant. The market's recent turmoil has been fueled by recession fears, with interest rate cuts, or the anticipation of them playing a pivotal role in shaping investor sentiment. The Federal Reserve's actions, or lack thereof, have left many wondering about the future of economic growth. Interest rates are like the heartbeat of the economy, influencing everything from borrowing costs to investment strategies. When rates rise, borrowing becomes more expensive, affecting everything from mortgages to business loans. This, in turn, can slow down economic growth as companies become more cautious about expanding and consumers tighten their belts. The impact on investment strategies is equally profound. Investors are reevaluating their portfolios, trying to balance risk and reward in an environment where the cost of borrowing is on the rise. Some are holding on to cash, waiting for the right moment to jump back into the market, while others are diversifying their investments to hedge against potential downturns. The Federal Reserve finds itself in a tricky position, trying to balance the need to control inflation with the risk of stifling economic growth. Historically, interest rate adjustments have been a delicate tool, often used to navigate the fine line between encouraging spending and maintaining stability. Investor sentiment is mixed, with some hopeful for a turnaround and others bracing for more turbulence ahead. In this uncertain landscape, it's crucial to stay informed and adaptable. The lessons from the stock market crash emphasize the importance of building a resilient portfolio, understanding market dynamics, and not overreacting to short-term fluctuations. As we navigate these challenging times, remember that knowledge and preparation are your best allies in weathering the storm. The market's ups and downs are part of a larger narrative, and staying focused on the long-term picture can help you make the most of the opportunities that arise. Chapter 4: The Tech Stock Conundrum. As we continue our journey through the stock market crash of 2024, we find ourselves in the midst of a tech stock conundrum. The overvaluation of tech stocks, particularly in the AI sector, has played a significant role in the market's recent upheaval. Investor confidence has been shaken as valuations soared to unsustainable heights, leading to increased market volatility. Tech giants like Broadcom, Tesla, Adobe, and Nvidia have seen their stock prices skyrocket, driven by the AI boom and the promise of transformative technologies. However, as these valuations climb, so do concerns about their long-term sustainability. Investors are beginning to question whether these tech titans can justify their lofty price tags or if a market correction is on the horizon. This situation impacts both established tech companies and emerging startups. For the giants, the pressure to meet high expectations is immense, as any misstep could lead to significant losses. Meanwhile, emerging startups face the challenge of proving their worth in an environment where investor confidence is fragile. This uncertainty has led many investors to reevaluate their investment strategies, balancing the potential rewards of tech investments against the risks of overvaluation. Despite these challenges, the tech sector continues to hold promise. The potential of AI and other technological advancements suggests that, while the correction may be necessary, the long-term outlook remains optimistic. Investors are advised to stay informed and adaptable, recognizing that the current volatility is part of a larger narrative. As we navigate this landscape, it's crucial to balance optimism with caution. The lessons from the stock market crash emphasize the importance of understanding market dynamics and making informed decisions. By staying focused on the long-term potential of technology, investors can position themselves to capitalize on future opportunities. Chapter 5: Navigating Market Declines. After all that drama, it's clear that investor confidence has been shaken, leaving many wondering how to navigate these turbulent waters. The market volatility we're experiencing is a stark reminder of the unpredictability of financial markets, but it also presents an opportunity for those who are prepared and strategic. In times like these, maintaining a calm and collected approach is crucial. Panic selling can lead to missed opportunities, as some of the most significant market recoveries occur after sharp declines. Instead, focus on long-term planning and resilience. Diversification is a key strategy. By spreading investments across various sectors, you can mitigate risk and position yourself to benefit from growth in different areas of the market. An emergency fund is another essential component of a solid financial strategy. This safety net ensures you won't need to sell investments at a loss during a market downturn, giving you the financial flexibility to weather the storm without derailing your long-term goals. Dollar cost averaging is a powerful tool during turbulent times. By investing a fixed amount regularly, you can smooth out the effects of market fluctuations, buying more shares when prices are low and fewer when they're high. This disciplined approach can lead to significant gains over time and helps maintain a steady course amid uncertainty. Reflecting on past corrections and applying those lessons to your current strategy is vital. Stay informed about market trends and economic indicators, but don't let short-term noise dictate your decisions. Instead, focus on the bigger picture and the potential for future growth. As billionaire investor Mark Mobius suggests, holding some cash on the sidelines can be advantageous, allowing you to seize opportunities when the market stabilizes. Ultimately, navigating market declines requires patience, strategy, and a focus on long-term success. By staying calm, diversified, and informed, you can turn market challenges into opportunities for growth. As we conclude our exploration of the stock market crash, remember that every end is just a new beginning in the world of investing. As we wrap up this deep dive into the stock market crash of 2024, remember that navigating these turbulent times is a journey, not a sprint. We've explored the intricate dance of interest rates, the tech stock conundrum, and the strategies to weather market declines. It's a lot to take in, but isn't that what makes the world of investing so fascinating? The market's ups and downs can feel like a roller coaster, but with the right strategies, like diversification, maintaining an emergency fund, and practicing dollar cost averaging, you can stay grounded. It's about playing the long game and keeping your eye on the horizon, even when the road gets bumpy. Now, here's a question to ponder. In a world where market volatility is the norm, how can we redefine our approach to investing to not only protect our assets, but also seize the opportunities that arise from uncertainty? Let that simmer as you consider your next move. And remember, like I mentioned earlier, every market crash is not just an end, but a new beginning, a chance to learn, adapt, and grow. If you found this video helpful, don't forget to like, share, and subscribe for more insights. Until next time, stay curious and keep investing in your financial future.